Want to build your career with CMI confidence? Well, it all starts with the tools at your fingertips. CMI creates workplaces full of inspiring leaders with its on-demand resources, network of mentors, and industry-leading accreditations. Search CMI Confidence today.
This session is recorded and will be available on the CMI website and YouTube channel. Join the conversation by using the live chat box for your questions and comments. We'll answer as many as we can during the Q&A.
Good afternoon, everyone. Welcome to the Understanding the Investor Mindset digital event. My name is Cleo Taylor, and I'm an event delivery coordinator at CMI. Don't forget to join the conversation by using the live chat box, and we'll answer as many questions as we can during the Q&A. I will now hand over to Will Cass, event lead at CMI West Midlands and Northwest Regional Board, to begin the event.
Hi there, good morning, good afternoon, or good evening, wherever you are joining us from. We wish you a very warm welcome to the West Midlands and Northwest Regional Board session today on understanding the investor mindset. We are joined by two illustrious speakers, Christian Brown and Adrian Burden, who I will introduce in due course. It's worth reflecting a little bit on why today's conversation is so important to understand the investor mindset. One only needs to pick up a newspaper to see that the world is awash with news of investors, of valuations, of billionaires, of winners and losers. Indeed, here in the UK, as we head into a general election, there is much talk of growth engines, of investors and of business driving the UK forward. But what does it actually mean, and what sits behind those headlines? Who are the people? What's the thinking, and what are the organizations that are driving that? In the final quarter of 2023 alone, $4.9 billion were raised by UK businesses, by VCs alone. And if we go more widely across 2023, global private equity fundraisers a total of $1 trillion a year, with over $13 trillion under management. So with such large numbers being thrown around, and with company valuation often being viewed as the primary metric of success for a business, and with entrepreneurs being celebrated as morally good drivers of growth, what are investors looking at, and how do they think? This can have a profound impact on how we lead and manage organizations, be they commercial or government. You certainly don't want to hear from me on these subjects. I will be learning as much as everyone else on the call. So I will be introducing our first speaker, who will be the first of two to speak. They will both speak for 10 minutes before we go to reflections and Q&A. We would actively encourage you to leave any questions in the chat, and we'll do our best to get to them. Should we not, we invite you to join us on our LinkedIn page, where we will continue the conversation. The first speaker today is Adrian Burden. Dr. Adrian Burden co-founded and grew an award-winning anti-counterfeiting solutions company headquartered in Singapore called Singular ID, which was later acquired by leading pharmaceutical packaging supplier Billcare. Adrian then co-founded Key IQ Limited, a business and technology catalyst that operates the Which Innovation Centre for the benefit of entrepreneurs keen to start and grow their own businesses. Currently, Adrian is co-founder and chief executive officer at the blockchain startup Blockmark Technologies, and he was listed as a Maserati 100 entrepreneur by the Centre of Entrepreneurs in the Sunday Times in February 2015. He is the author of the book Start to Exit, How to Maximize the Value in Your Startup, published in 2017, and Inspiring Outside the Box, another book, the 10-year backstory to the Malvern Festival of Innovation, which was published in 2022. With that in mind, I would like to thank Adrian for his kind attendance and his insights, and pass the ball to him. Hi there, Adrian.
Hi, Will. Thank you very much. And thank you for the introduction. Great to be here. So what I'm going to do is take you through a little bit about, from my perspective, what I think investors think about when they come to invest in your business. So as you can see, my web address and email will be at the end if you want to contact me afterwards about anything. But just very briefly, in terms of the background, obviously Will gave you a potted history, but what I just wanted to sort of stress was that I'm actually a scientist by training. And so I've become a tech entrepreneur. So I'm not trained in financial and accounting matters. And therefore, when I came to start talking with investors and trying to understand their mindset, I think, like a lot of people, it was a mystery that slowly grew, and I got better understanding as I went through the journey. I've been involved in a couple of different startups, and one of them right the way through to exit. They've always been technology focused, and a lot of my experience will allude to that as we go through this presentation. And I think that actually makes it a little bit more complicated, because the technology element adds a bit of added risk and unknown, as well as potential value to your business. And this is something you want to get across to investors when you're negotiating with them. So the first thing to think about actually is, when you're starting, growing, and eventually hopefully exiting a business, you're going on a journey. And as you go on that journey and bring your staff along with you, you're also going to be bringing investors along with you. And those investors will change and adapt as you grow the business. So in the early days, we talk about friends and family investors and angel investors. These tend to be less sophisticated investors. They probably won't ask as many questions. They won't have as much experience. They'll be much more trusting in you and your management team or your founding team. As you get bigger and the amounts of money grow that you're talking about and the potential grows, that's when we talk about Series A, B, C, and go on, Series E investments. That's when the bigger investment companies get involved, and the people that are more sophisticated and more experienced at becoming an investor. They will have had a lot of experience with other companies, and so they tend to know the kind of questions to ask, and this can obviously be intimidating to founders who are doing it for the first time. And then I think the important thing to understand is that at some point there needs to be an exit, because an investor, primarily the investor mindset, is they want to make money. And often the only way they can make money is through an exit of some kind at the end. And I'll talk a little bit about what we mean there. But I've put there examples include things like a trade sale, some kind of management buyout, or an initial public offering where you list on a stock market. What it also is about is, I put here, it's sort of growing the pie. So as you're going through this journey with your business, what you're actually trying to do is grow the value of your business. So obviously a business is about making money, being sustainable, and having profits. And you need investors to help you do that, possibly helping with cash flow or early stage growth. And as you're growing, your business is hopefully growing bigger and bigger. And you can think of this like a cake or a pie getting larger and larger. But people have different slices of that pie. Their stake, equity stake, for example, is reflected in how the pie is cut up. And that will change. That's a dynamic process as you go. And so, again, coming back to how investors think, they'll be thinking about your company in terms of its value, what value proportion they have, and what its potential is in the future. So taking a step back, the first thing I think is to understand the business itself that you're trying to grow and attract investment into. There's various components in your business. There's going to be your staff, and in particular your management team, and how capable they are, but also the gaps that might exist. And that might be why you need investment to start filling maybe some senior management positions or to grow the team. You'll obviously have accounts, and the later your business is in its growth cycle, the more detailed those accounts will be, and hopefully the better those accounts will look from an investor's standpoint. There will be a variety of agreements, and agreements can be both assets and liabilities. If they're bad agreements tying you into things, those can cause problems for investors who don't want to take on board some of the things you've agreed to in the past. Obviously, you're going to have products and services. These are the things that generate the cash. Investors will be very keen to understand the differentiators of your products and services. And underpinning that, you'll probably have some intellectual property, classical stuff with things like patents and design rights, but also your know-how and your trade secrets and things within your business that enable you to operate. And then on top of that, you've got how your business is intending to grow into the future. So an investor will be very keen to understand your roadmap, and associated with that, your business plan, and to understand what their money is going to do and how it's going to improve the business going forward. So I've got here a very quick shot of a roadmap. And the key thing here is to be looking into the future and convincing the investor that you've got a plan. And the plan should include things about what you're going to sell, what you're going to develop, and how you're going to meet different market and business drivers. In other words, do you really understand the market and business that you're operating in and how that's going to change into the future? And there's various methodologies you can use to put roadmaps together. You can look those up on the internet as well. But they're really the kind of top level basis of the business plan. Now, investors themselves come in a variety of different flavors. First of all, it depends where the money is coming from. Some of them will be investing their own money, and these are usually, well, friends and family, as we talked about right at the beginning, but also potentially angels who are wealthy individuals who've maybe gone through the cycle themselves and made some money and wish to invest in other companies and work with other founders. But also the money might be managed, and venture capitalists tend to manage other people's money. So they're a bit detached from the source of the funds. They're responsible for generating a return on behalf of a group of other people. And then as you go through in the sophistication, you might have things like venture capital trusts, which tend to, in the UK at least, offer investment into slightly more sort of larger companies, those that have been around longer with potential. And then pension funds will invest in even more mature businesses. A lot of investors have constraints. So this means they've got to invest in a particular sector or a particular type of business in a particular area. They might also have tax incentives. We don't need to go into the details, but in the UK, there are things like SEIS and EIS, which are schemes that are aimed to encourage investors to take risks. Investors will also have a time frame, and certainly funds will have a time frame when they're expected to return investments to their investors. So this is both in terms of investing the money. They'll have a milestone in which most of what they've got should be invested, and then they'll have maybe a 5-year time frame in which they need to divest. And this is crucial because it needs to tie in with how your business is going to grow and whether you can meet with those timeframes, both in terms of taking the money in, but also returning it to the investor in the future. And as I mentioned, investors come in a whole different range of sophistications and experience. And often when they have been burned in the past, that means they ask more and more questions about that in the future. So they try and learn from their mistakes. And finally, in terms of expectation, I would say most investors are looking at an equity stake that then gives them a capital return. But there are other kinds of ways of getting investment, and that can include things like loans and so on. So be very clear what kind of investment you wish to have, and also what the investors are expecting in terms of maybe a capital gain or dividends paid out over a period of time. Now, I'm not going to go into a lot of detail here. Suffice to say that depending on the sophistication of the investor and the investor's mindset, they will have a lot of things that they will expect to have in an agreement. And this is really to protect them. So you need to try and understand what those protective provisions are. I've listed a few of them there. And if you don't understand them, read up about them or get an advisor. I'd certainly encourage you to have a legal advisor to check through investment agreements and investment terms before you commit to anything. And obviously, the more experience you have talking to other entrepreneurs, you'll get a better picture of what works and what doesn't. You can also have provisions that protect you in an investment agreement as a founder, but you've got to put them in. So you've got to negotiate with your potential investor on all of these terms. And actually, the bottom line is that it is a negotiating exercise. So the more you can put yourself in the position of the investor and understand what they're looking for, and then come up with something that is mutually agreeable, the quicker things will progress. The other thing I wanted to show you very quickly was the capitalization table. Again, you don't need to go into the details here, only to say that these are a way of monitoring who has the different slices of the pie. And each time you take on an investor, we would call that a round, an investment round. And then that pie, as I showed you, changes in terms of its composition. That's important to monitor, partly because you've got to keep track of who owns different proportions of equity, how many shares have been issued, but also because there's a management or a decision dynamic in there. People have voting rights associated with their share proportions usually, and that means that different groups can influence and veto different things as the company progresses. And so you need to keep on top of that as well. You may have been the founder at the start with a 50% stake or 100% stake, but as you take on investors, that means that you're going to have less and less direct influence and power in your company. And a capitalization table is one way of keeping track of that. It's also a way of keeping track of notional value, both in terms of present but going forward, and attracting investors. And they'll be looking at how much of a proportion they have and the power sharing dynamic. And then the capitalization table can carry on through, right through to exit. And that leads me to the exit. So the exit really is part and parcel of your thinking when it comes to taking on investment. Because as I said, this is the mechanism by which investors can make money. What this basically means is that the shares and the investment that they put in or have been issued, the shares that they've been issued, have some value that can be cashed out in effect. Now, as a founder, you've also got to negotiate the exit as well. And the thing with an exit is you're basically negotiating with an acquirer. But an acquirer also has a similar mindset to an investor as well. They're basically taking on the whole of your business or a big proportion of your business in terms of an exit. And so again, it's a negotiation. You need to understand what they'll be looking for, and also protect yourself in terms of how you're going to carry on working with the company under new ownership as you go forward. And that includes not just compensation, but how long you're going to be doing it. Remember, although it's termed an exit and the investors may exit and make their money, that's not necessarily the case with the founders. There's often a workout, more milestones before you've completely cashed in your chips. So very, very quickly, that is a summary of what I think about the investor mindset. As Will mentioned, I did write a book about it from some of my experience. That's available if people want to have a read. But otherwise, more than happy to hear from you or, of course, answer questions after this. Thank you very much.
Thank you very much, Adrian. Great insight and an excellent book, I have to say. I have purchased and now read the book since we first started communicating, and it's brought many different concepts to life for me. So I thank you for taking the time to write it. We'd now like to introduce Christian Brown to the table. But before we do that, I think it's very important we recognize his going above and beyond the call of duty. Christian Brown is based in Colorado, USA, and it's about 5 a.m. where he is. So a huge thank you to Christian for choosing to be with us this afternoon. Christian is the CEO of HobbyDB, a project to document every collectible ever made, which is an estimated 100 billion. Prior to that, he ran the world's biggest collector forum business, the largest eBay business in Europe, and Germany's only national youth radio network. He worked in private equity for General Electric, in strategic consulting for Baines & Company, and is an M&A advisor for Intrepid Ventures. Christian studied business administration in Saarbrücken, Glasgow and New York, and holds an MBA from London Business School. Christian was involved in more than 100 corporate investments and exits in more than 20 different countries. A man with many years of experience and insights. I'd like to pass the ball to Christian and say good morning.
Good morning to you, Will. Thanks. And good morning to everybody else. Now, since Adrian wrote the book on this whole thing, I thought I find out what are the things that I would have liked to know 30 years ago and share those with you. So let me see. Will, I apologize. I think there's about 86 transactions that I was involved in. So when I said 100, I wasn't quite right. But I've been doing this for a long time. I've been on many boards, and I've seen the world as an investor, as a venture capitalist, as a private investor, but also as an advisor, an M&A advisor, and as an operator. And what I wanted to share is just a few pieces of advice, starting with angel rounds. And as I saw Adrian talking about friends and family, I would advise to be very careful with family. Investments often, when they come in early, last 10 years. And there's no fun meeting your uncle and every time being asked how the business is going, particularly if the business is not going very well. The same with very close friends. So I'd probably stay away from close friends and family. And then angel rounds tend to be complicated to put together because most angels only invest a certain amount. Here in the US, it tends to be $50,000. In the UK, I found it's often £25,000. So you got to, if you need to raise 200,000, you need to find 8 people. And angels tend to be wealthy and have complicated lifestyles and hard to find. And really what you need to focus on is find that lead investor. The lead investor is the guy who will agree with you on all those provisions in the contracts and the valuations, et cetera, et cetera. So focus on that. If you don't have a lead, you're not having a round. You may have 6, 7 people saying, I invest, but I'm not going to lead, which is very, very typical. So concentrate on finding that lead investor, and if needed, give up some equity for that, or give up something for that. So once you have that lead investor, they will also help you then closing down the other people, and the round will be fast. And then note that angels really do not like to say no. So you talk to them about an investment, and they often move into this hold pattern where you don't really know if they're coming in or not. So some will tell you no immediately, and that's really what you want. When you talk to an angel investor, you want to either hear no or yes, and if it's somewhere in between, you really need to know where it is. So go in deep, ask questions, understand where they are with them maybe, and make notes, and find out what it is that they need to see before they can commit and come in. And then funny enough, they don't like to tell you that. Sometimes they don't know themselves. Sometimes they just want to go along for the ride because it's an opportunity. You know, if you introduce an investment and they're not 100% there yet, by saying no, they're out of the game. By saying maybe, they will get updates, they can look at that, and if you're doing amazingly well, or if you get other amazing investors, then they will contemplate again. So when you get a no, you want to also dig deeper. You really want to understand why they said no. And again, people don't really like to tell you. And the reason for that tends to be that they've, in the beginning, shared feedback freely, and then the companies turn around and solved all these problems. So let's say you introduce a deal, and the worry is about distribution and sales. Well, amazingly, 2 days later, you have a new sales director, or you have this, or you have that, and come back to them. And that's not what they want, because they know it takes longer to solve these problems. So what I found works is, if you get a no, go back saying, look, I got it. You said no. I'm not going to come back to you for a while, but it would really help me if you explain to me why that is, and then really try to go deep into understanding it, and then take your time, consider that feedback, and see which one of that's valid and which one of that you really have to address, and which ones is just an opinion that you may not necessarily share. And then here's something about what I call bad intros. If somebody's not investing, do not take an intro. Often people say, look, it's not really right for me, but if you push, or maybe sometimes they even offer an introduction, remember, if an investor gets an introduction from another investor and that investor does not invest, that is just the kiss of death for and you better off not getting the reference or going in cold. So I'd rather ask for a name and go directly to that new person. And you will have to do all of that if you raise an angel round. You have to, you need 10 investors. Therefore, you probably have to do 200 conversations. And then there's this interesting rule of 30%. It almost seems to be not mattering how much money you're raising. The new round wants a substantial part of the business, but not a majority. So, you're better off skipping one of those steps. Instead of raising 100,000 and then $1 million, it's almost better getting to 500,000 than 3 million, because it does keep more of the equity with you. So not all of the investments are done on a totally irrational level. There's always that having a substantial part of the pie, the cap table that Adrian talked about earlier, that you have to keep in mind. And then be open to barter. I have got loads of services in my operating businesses, for example, my rent, through equity. So see who else is out there. There's nothing more precious for a new business than cash. and in the beginning you have an overhang of equity. So use that to preserve cash, be able to raise less money, and also bring in people much closer to the business. If you have equity for rent agreement, you will have a much closer relationship, for example, with your landlord. And think about everything else that you're using, where you can use equity as a potential component of payment. And then, as mentioned earlier, you will need a lot of people to talk to, a lot of frogs to kiss. So you need to network. You need to go out there and speak to entrepreneurs, maybe your professors back at business school, other professors that they knew, network managers, people like Will here. Just go out as much as you possibly can to find new names, and then very quickly, like I said earlier, try to get those people to either say no or tell you maybe, and then find out what that maybe is based on, or get a yes. And when you get a yes, make sure you communicate with those people during the process. And then lastly, consider crowdfunding. Crowdfunding is becoming more and more popular. There are more platforms. It works well. We've done it 5 times, but you have to have the right audience for it. So, it works really well if you have a consumer proposition. And then crowdfunding is not just fundraising, but it's also marketing and sales. So consider everybody that comes in as an investor, also as a potential customer or service provider. And that concludes my presentation. Back to you, Will.
Perfect. Thank you so much, Christian. Really insightful. And I think shortly we'll also be inviting Adrian back to the room, where we will be discussing some thoughts, I think, from what came up. Both of those talks shed a lot of light in different areas that many of us are thinking about. I've, as Christian alluded to, been working in the startup space for a few years. I'm fortunate to be being mentored by a man far more experienced than me in the space, so I can understand how disorientating the space can be. That said, one of the great strengths of the Chartered Management Institute, our host for today's conversation, is that we have managers from all walks of life and all kinds of industries and organizations. And I suppose the first question that came to my mind, which is my question rather than one that's been submitted, is how, in your experience, how do you select your early stage management teams? And what qualities are you looking for? And how are these qualities different from the sort of qualities you would want in your management team in a more mature business? Is that something that you've put any thought to? Perhaps, Christian, you'd like to go first?
Totally. I mean, running a startup is totally different than running an established business. It's basically 2 jobs. You have to create everything, and then you also have to run it. And it takes a certain type of mentality and mindset. So I would say attitude and energy are more important than necessary experience in the early days. And if somebody wants an 8 to 5 job, they're not really right for this. You want a small, close-knit team that goes through a lot of excitement, a lot of disappointments very, very early on, and people that don't just have one hat. When you start a business, you have to do everything. You have to create door passes to get in and sign contracts. Later on, everything departmentalizes, and then people can be specialists. And it's the same with the CEO. Right? I mean, over the lifespan of a company, if everything goes well, it's very, very different to run a business to $1 million than from $1 million to, say, $20 million, and then from 20 million onwards. And most people, for example, I love that first part. I think I might be okay with the latter, but it's not really my thing. So, you bring in a professional.
Fantastic. Adrian, similar to your experiences?
Yes, the management team has to evolve. I think one of the things I found is having a co-founder early on is really helpful, because you've basically got a partner who you can bounce ideas off, who's hopefully a good friend, as well as somebody you're doing your business work with. And actually that means that you can share the experience. And if you're feeling down one day, hopefully they're not, because it is a roller coaster ride. So I would say certainly try and found a company with more than just you. And then, yes, expect your management team to evolve. As Christian said, you start doing everything at the beginning, and then that sort of crystallizes out into different job functions as the business grows. And to add to that, I'd be very cautious about giving everybody the sort of CXO, the chief this and chief that title at the start, because when your business is more mature, that's when you want to have those titles, if you like, available for the really experienced chief financial officer and so on. So don't give your high-end titles away too quickly. That's another bit of advice.
I just like to add to that, because you can lose people if you don't do that. You have a marketing director or a head of marketing or CMO, and then you want to bring somebody else in. People hate demotions, and even if it's just a title.
Yeah.
Absolutely. So I guess then that brings the question of culture that you're bringing to this startup as well. And there's a lot being said about businesses, larger businesses, about being more nimble, more agile, more startup-like. And a lot of the emphasis seems to be on culture surrounding startups. I wonder how important is, and it's a leading question, but how important is culture then to a small startup? And what are the challenges of maintaining that dynamic as the organization grows? I imagine some of those joining us today may be thinking about that as they work in some larger organizations, Adrian.
Yes, so I mean, culture is all important in a small company. It really defines how it's going to operate, and that really takes its cues from the initial founders. So a lot of how the company morphs and grows is really the values that the founders have at the start. And then bringing it back to the investor mindset as well, the investors will look at the culture in your company and decide whether it aligns with what they want to get involved with. And you also need to look at the investors, certainly in those early stages, and think, well, do they align with my values and my goals and what I want to do? You might not want to just make lots of money at the start, whereas an investor might want to make lots of money at the start. And that can be very divisive.
Similar experience to you, Christian?
I would say two things. One is, if a startup is not nimble, it doesn't have anything. I mean, the only thing that you have as a startup, you're nimble. The big guys have all the money, they have all the people, they have all the resources, they have all the clients. So that's the one thing you have. You can move within a day, within the weekend, you can make a change. A large company takes 3 weeks. You got to explore that. You got to have that. And then the other thing is, it's all up to the CEO. If there's two founders or two co-founders, what they do, if they don't have the right values, nobody else will. If you meet the CEO, you know a lot about the team, and vice versa. If you meet one of the people, you know a lot about the CEO.
Mm-hmm.
So here's my final question that I'm going to ask before moving to some of the pre-submitted questions by those joining us today. As I go to my final question, I would also actively encourage anyone joining us today, if they do have any questions or points, please feel free to put them in the chat, and we'll do our best to meet them and answer them as we go along. The question I had, and it's one I've experienced, is the question of pressure. It feels like a slow ticking time bomb at times when you're working for a small organization, particularly as the person responsible for sales, let's say, but anyone in the organization looking to drive the business forward. How do you handle the pressure of working in a company with either investors or with a burn rate that they're very aware of and targets that they're trying to meet? How do you handle that as individuals, Christian?
Well, I mean, if you start a business, you're so likely to very often run out of money, or lose a big client or lose an important person. As a big company, it's not a big deal, but for a small company, it is. So you need to basically compartmentalize. You need to say, look, I do my very best, and I'll prevail. You need to be an optimist. You can't do it otherwise. You need to be an optimist. We're going to fix this. I'm going to work as hard as possible. And then you need to put those things behind you and move on.
Understood.
Yeah, no, I agree. I mean, it is a lot of pressure on lots of moving parts. That's why I've got no hair anymore. And I think the thing is, again, if you've got a founding team, you can share what's going on. That helps immensely. So, that's why having a mentor as well, as you said, or even those early stage investors, the angel investors that probably have been through similar things, depending how they've got their wealth, but also hopefully they have some domain expertise or some experience of what you're facing, because you will have a whole myriad of issues. It's not just money, it's people, HR, hiring, firing, products don't work, will be recalled. Pretty much anything you think about will happen really quickly. And in terms of coping with it, as Christian said, you've got to compartmentalize what you're doing, but also you do need to be able to step back and assess the risk of kind of ask, well, what's the worst that could happen, and make sure that you can cope with that. You have to shut it all down or whatever. So, yeah.
I'd like to add one thing to that. I get often, I'm part of a network called Techstars, and people come through and ask questions about, I want to start a business and I want to still run my day job and do this. I'm like, don't start a business. If you want to run a day job, you're not ready. You need to basically take 2 or 3 years aside and saying, I want to do this thing. It might take 2 or 3 years, and I might lose the money I put in and the business. And that's what it takes. If you can't do that, stay in a job.
Excellent. Thank you. Some great food for thought. With that in mind, I'd like to move to our first question, or first of the submitted questions. The first submitted question is from Ian, who asks, how do investors assess ethics of a company before deciding to invest? How do investors assess ethics of a company before deciding to invest? Christian, would you like to go first?
I turn around. I look at who's coming in, who's investing in my business, and the ethics are important. In a crowdfunding, you can't do it. In an angel round, if you get 12, 15 people, you can't really check everybody. But your lead investor is important. The person that joins your board is important. Make sure you can see eye to them, because same as the contracts, they only come to life if there's problems. If there's a problem, you will find out if this other person is a nice person, has good ethics or not. And it's better to try to find that out before. So spend time with your lead investor. Same with your management team, right? Spend time with them, because when the shit hits the fan, that's when you see what they are, and you really want to get there.
Absolutely.
Yeah, and it is a two-way street. So you need to look from an ethical point of view at your potential investors, not just where has the money come from. That could be an issue as well, but also, how have they acted in other companies? What's their reputation and so forth. And equally, they will be looking at your business from an ethical standpoint. Depends a bit on the fund, but potentially they will have certain sectors that they can't operate in because of ethical issues, or they might have environmental concerns and so on. So it largely depends on what their requirements are and their restraints are as well. But obviously, it's got to be a lawful business apart from anything else.
So it sounds as if you have to know which kind of investors you're talking to and what those constraints are, Adrian. So that's something that would come up in research even before engaging, or you would be effectively wasting time. Is that about right? Yeah,
I think so. Yeah, you should definitely research potential investors. Yeah.
Fantastic. Thank you. Our second question is from Misbah, second submitted question, which is, what is the best way to manage investor expectations throughout and until return is received by that investor? What is the best way of managing investor expectations? Probably a loaded question. I saw a couple of smiles on both your faces. So I assume you've both worked with both some very understanding and some very, very difficult investors. Christian, would you care to go first?
Sure. I suggest you come up with a number of key factors that you report every month on, or every quarter. And if you do every month, every quarter, don't change that. Stay stable with that. So do your monthly, do your quarterly, do the same set information. You can add new attributes to it, like eyeballs, web wizards, or something. If you remove from it, you got to carefully explain that, because that is a red flag for people. If you've reported something for a year and now you don't report it anymore, they will want to know why. So just be consistent. Tell them the same thing. If you make a change, explain that.
Yeah. Yes. And also, one of the things we did was have regular board meetings, which usually the investors are involved in. Usually an investor, or at least the lead investor, will take a position on the board, or they might observe the board. But the key here is that they're in with the management and the sort of decision making. And what we did is we wrote board reports, actually every quarter. That was sufficient. But in those board reports, we wrote down all the good things and the bad things that were happening, so there were no surprises, no skeletons in the closet. And in effect, we were explaining the problems in the business as well as the achievements. That's both helpful for the investor as they're going along, but also it provides information for future investors when they come to do their due diligence. You can give them all the board reports. It's up to them to read them and to understand, the various problems you've had over the years. It means you're not hiding anything from them.
And I would imagine it would be really quite different depending on the investor type. We, of course, earlier, Adrian, when you started your presentation, you showed us the different types of investors, and we looked at family, we looked at angels, and we looked at more institutional investors as well. I would imagine that handling family or early investors and even potentially angels might come with higher levels of, I suppose, emotional challenge. Perhaps not quite as structured or methodical in their approach. I suspect that some of the private equity and VC organizations will come to things with a pre-existing framework, a structure, a set of assumptions. Gentlemen like Christian, who have worked on 86, not 100 boards, projects, but nonetheless a huge amount of experience. And so I would imagine how you start to handle those different kinds of investors would be very, very different and potentially problematic at some point if you have a whole bunch, you have some angel investors, you have some early investors, and then now you're moving into that space where you have some more institutional, where you're big enough to be noticed by some of those institutional investors. So is that the case where you have quite a fractious a different relationship with all of these? How do we handle those, Adrian?
Well, you're absolutely right. Because the investor groupings evolve, so do their expectations on reporting, particularly. I mean, as a business gets bigger and more mature and the money involved is bigger, there are many ways that you can account for that and so forth and report on it. So what I found is that you obviously have to explain to those early investors how things are becoming a bit more sophisticated. I also think it's worth starting as you mean to go on, which is, if you produce board reports, for example, they don't have to be very long, but you've got into that habit, you're providing those to the angel investors early on. They will sort of get into the mindset that this is a serious undertaking. And as new investors come on board, hopefully they'll be prepared that they need to see the business as something that's maturing as well.
Similar to you, Christian?
I would add two things. As I said earlier, I don't really like family. I don't ask my family to invest. Bad idea, I think, because of that communication. You don't want to have dinner with all the family and this thing comes up, and it will. Same with close friends. Leave those aside. And then secondly, almost every entrepreneur starts with really good reporting. First 3-4 months, every month there's a report and it's good. And then the business is getting difficult. You have very little time. You drop that communication. It's a mistake. You need those communications when it gets hard. No angel investor wants to hear from you when you suddenly have a problem and you need more money. If you have told them across the period, they can see it. And then they might come say to you, look, looks like you have a problem. We need to talk about funding or something. So no bad surprises, and surprises are generally bad with investments, are a big problem, and people shy away from you. So you got to be super open with your investors and tell them.
It sounds like the message is it's about maturity of relationship and about being ready to communicate strengths and weaknesses and having that, taking the lead in making sure that everyone is updated with the information they need. And no wonder then that opens up a question from the investor side, thinking about understanding the investor mindset. I would imagine that there are CEOs and leaders of startups who have come across very polished and accomplished with fantastic business plans that have stood up, who folk have invested in, who have perhaps, for whatever reason, for the pressure, have started to become a little more wild or not quite as things had expected. It's also the case, I think, that when we talk to entrepreneurs or business leaders, whether or not they work for themselves, that they're concerned about losing control of their business. So what's the investor mindset when looking at the lead founder or the founder of a startup or of a business? Is there a way, what kind of qualities are you looking for? And do you try to mitigate some of the potential risks of human elements that can come up during the course of a business relationship like this, Adrian?
Yeah, I mean, the senior management, the CEO are crucial. The investors will be looking very closely at the team and the leader. I mean, again, it comes down to personalities, certainly in the early days, because it's a smaller business, and there'll probably be, they'll be probably working together more closely. As the company grows and bigger investors come on board, they will probably have questions about the CEO in terms of, are you suitable to take it to the next level? Should you step aside and bring in a more accomplished CEO who understands, the next stage of the business? Maybe that's exporting, overseas growth, listing on a stock market. So I think the founding CEO and other senior management, senior founders should be prepared and understand that this will possibly be required by investors, and be open to that discussion, because actually that's probably how the company will carry on being a success, and therefore you, who've put all the effort in up until then, can carry on hopefully benefiting from it. But it's hard because it's your baby if it's you.
Of course.
I'd say two things to that. One is the board only has two modes. It's to 100% support the CEO unless it stops doing so, and then it has to find a new one. So the board is really meant to be supporting you, and as a CEO, you want to make sure that they want to keep supporting you, because their job is basically to decide if you are the CEO or not. That's the board's role. And then secondly, I disagree a little bit with Adrian. I think the new person is not more accomplished. They just have different experience. The new person is somebody who runs public companies, who has taken public companies public. I think it is actually more of an accomplishment to bring a company from 1 to 10 million than from 10 million to 100, because the likelihood of succeeding is so much lesser. But it's a different person. And as a CEO and owner of the business, you should approach it that you should constantly think, who are the best people to be in your business, and that's including yourself. So I mean, for example, I have offered Meg Whitman, the CEO of former CEO of eBay, the role as CEO of HobbyDB. She declined, but I would have been very happy to work for her and be the head of business development. I wouldn't have seen that as a demotion. I would have seen that as a promotion, because I work for somebody world leading. So always think about the best people to run your business, and that may not be necessarily you.
Makes perfect sense. And I suppose, again, it comes back to knowing when it's time to step aside, and no doubt the skills that brought you from 0 to 10 million, there'll be many other projects and opportunities once you've built out that skill set to reapply them in a different space. And imagine, like hen's teeth, few people have been able to do that. Okay, so the next question we have is from Viraj. The question is, what is your approach to negotiation and potentially compromise after pitching an investment opportunity? What is your approach to negotiation and potentially compromise after pitching an investment opportunity, Christian?
Well, so that depends always if this is an ongoing relationship or something that's a one-off, and also how much you know about the other one. If this is a closed relationship, and for example, if you do an angel round, your lead investor is going to be your close relationship. They are most likely the person that joined your board afterwards. You're going to work with those guys for 5 to 10 years. You don't want to fool the last one. I often use the term open kimono. I tell people, look, here's all the issues that we have. Here's the opportunity, so that there are no surprises. No surprises is always the key in good long-term relationships.
Yeah. Well, I mean, I think the key here is that you do have to negotiate, and there's a skill to negotiation, and you may improve with it over time, but there will be a negotiation. You have to be comfortable with that. You have to have internally, I guess, some red lines, some things you're not going to concede, but equally you have to be flexible enough to actually make progress. There's no point being so belligerent that you never get investment. So it's a balancing act. And I would say compromise is necessary. And that's why, the topic of this discussion is the investor mindset. You really do need to understand that the investors have some things that they need and want and constraints they need to apply and so forth. So go into the discussion expecting a negotiation. Have some ideas before you go in as to where you might be flexible.
The other thing I would like to add to that is if you feel the timing is right, so the information has been exchanged, try to get some private time. Just say, look, let's meet for dinner, lunch, let's have a coffee, and let's try to agree a framework, a deal, and agree on everything, not just this thing and that thing, and do it over emails back and forth. Sit down, if you can, sit down in person and flash out all the details, write them all down, handshake on it.
Absolutely. No, great.
And use negotiating. Sorry, Will, I was just going to say, use the negotiating period to assess the investor in terms of the working relationship. Are you able to work with them going forward in whatever capacity you think that they might be able to help the business? If the negotiations turn sour for whatever reason, you've got an early insight into problems that might happen later.
Absolutely. You want a win-win kind of person. You want somebody who can work with you, not somebody who just takes.
Yeah.
Because that will continue.
And so what are the indicators that an investor might be like that, who just takes from you rather than contributes early on? I suspect that's something you want to be able to tease out as quickly as you can in a conversation or a relationship with them. I suppose that's the skill, but are there any indicators that might help us spot the taker rather than the mutual agreement type of investor?
I would say ability to compromise.
Is that the same for you, Adrian?
It's really hard. Yeah,
I can see you smiling. Smiling like a man who might have worked with all sorts of investors there, Adrian. So,
yes. I guess the more time you can spend with somebody, and I agree with Christian, face-to-face in an informal setting as well, the more likely you are to better gauge their personalities, their strengths, and so forth. So don't rush into, it's not like selling a house where you're just negotiating and leaving. This is a long-term relationship.
A good investor realizes that the power shifts as soon as they put the money in. The investor has all the power when it's time to sign. They sign, they fund. Now the CEO has the position of power. That will change again when they need more money, but it's going back and forth. And you want somebody who doesn't abuse their power.
Very great way to put it, and thank you. With that in mind, I have a question here from Glenn Duckett, who left a message here for us. Please encourage anyone else to also leave messages, and we'll get to the questions as we can. What interest is there by investors in social and environmental impacts, and has this changed over recent years? And how can a business use this to gain investment or get better rates, if they can at all? Christian?
Well, there are, here in Colorado, there are a lot of impact funds. So, there is specific money for almost every purpose. You have a female management team. There are at least 20 funds here that fund only female management teams. You do something with an environmental impact, there are probably 100 funds that fund those, find those, talk to those people, because, they have a more limited scope and therefore a smaller world of companies they can invest in. You want to be in that.
Absolutely.
Yeah, and I think, the example given social environmental impacts, I think it's because it's more in the news, certainly environment and climate, there's going to be more interest both in making money out of that, but also being aligned when you're investing in these trends. It's often the case that when there are trends, there are investors or funds that are chasing it. So we see this in tech all the time with things like nanotechnology, artificial intelligence at the moment, electric vehicles. So when there's a fad, certainly that helps. And if you happen to be doing something that can leverage those, that might give you a bigger pool of investors to choose from.
It's a very interesting point, and I suppose it's important to leverage these new trends rather than pay lip service to them. I often go to conferences, and every technology conference I go to now, there isn't one organization that says we're not doing AI. Everything has AI. It's exactly the same product they had 6 months ago or a year ago, but it just has AI at the beginning of it, at the end of it. And every pitch or every conversation has the words AI in there. So I'd imagine that the world of investors, or I'd hope certainly the more mature institutional investors, are able to cut the wheat from the chaff, as it were, those who are paying lip service to FAD to hope to secure more investment, and those who are actually driving a value proposition that builds on top of that FAD. And I think that's probably one of the challenges for investors, isn't it?
It's true, but even if you're not in a FAD or not in some particular direction, if you have a good impact on something that people care about, it helps, right? I mean, most investors come into an opportunity wanting to say no. As an investor, you get so many deals, you get so many things offered. You're trying to find reasons to say quickly no. And the job of the CEO or whoever sells the investment is to get you to consider and then to say yes, i.e. not to say early no. If you have a good impact on the environment or something else, that's a nice one to have. Just make sure that you don't push it too hard. If people think that's the only thing you have, well, that's nice, but not good as an investment necessarily. So, use it, promote it as, and we also are good for X.
So I'm conscious that we only have sort of 3 minutes or 4 minutes to the top of the hour that we have together. I have time for one more question, and we'll answer those. The question I have here is from Jay Sierra, who asks, is crowdfunding a good way of raising finance? Now, I remember you mentioned this earlier in your conversation, Christian, having done so, but I felt it also came with a word of caution. So when is crowdfunding appropriate and when isn't it, please?
Well, crowdfunding works if you have fantastic numbers or if you do something cool, but then you can also get more normal funding. You can get a VC or so. So I think it is particularly good if you're either local or you have a big consumer following. So what I find working is the local restaurant, the local brewery. Don't know why, but they always work because you can have great perks and people invest. You get $100, you get $1,000 pounds, and you get 50% of your beer price or whatever. So it works very well for local companies, and it works great for anybody. There's a brewery in the UK, Brewdog, and they raised $150 million for it. If you have an audience, people that like your product, it's great because now you make them into ambassadors. They help promoting you, they become your best customers ever. So I would say it's fantastic if you have the right audience and have a way to reach them.
Perfect. Similar experience, Adrian?
Yeah, so I haven't actually had experience myself of using crowdfunding, but from looking into it, you've got to be very organized with your campaign. So just as the traditional financing and investments that we've talked about implies, you've got to be prepared to talk to investors. With the crowdfunding approach, you've got to be prepared with your marketing campaign and really be organized on what your offering is and the milestones, because it can very quickly damage your reputation if you don't deliver, because you've got a lot of people out there who are aware of you.
Fantastic. Well, thank you very much. And conscious of time, we only have about a minute left or so. I think I want to start by saying thank you to both of you for joining us today for today's conversation with the West Mids and Northwest Regional Board. We haven't been able to go through all the questions that we've been asked over the last hour, but what we would kindly suggest to those whose questions haven't been answered to please re-ask them on our Northwest on our CMI LinkedIn page, where we will hope to get the answers to you and where we'd like to carry on the conversation. A final word of thanks to Christian and of course to Adrian, but particularly to Christian for his ability to sound cohesive and coherent at 4 o'clock in the morning. As a father of some young children, I find that a struggle. So you are
coffee.
Okay. So the coffee in Colorado is what drives the founders to it. I see. So thank you so much to both of you. Really, really appreciate it. On behalf of myself, the West Mids Regional Board, and of course the Chartered Management Institute, we thank you both very much for your interest in what we do, and we appreciate it. And with that in mind, I'd like to pass back to Cleo.
Thank you.
All right, that's it for today's session. Thank you to our host, Will, and to our speakers, Christian and Adrian, for your insight and expertise. Please stay tuned to hear more about
Is anyone
CMI
else having
membership.
challenges hearing Cleo?
Can't hear me?
I can hear you.
Oh, sorry about that. So please stay tuned to hear more about CMI membership, and thank you so much for joining us.
Don't forget, as a CMI member, you can find the latest management and leadership insights at managers.org.uk. If you're not yet a member, join our community to discover CMI Confidence with on-demand resources, our network of mentors, and industry-leading accreditations.